Hi, I'm Khleif. Each and every week, I record an interview with a thought leader that I know you're going to get a ton of value from. Now, here on YouTube are the video versions of my podcast, Lifetime Cash Flow Through Real Estate Investing. Now, to make sure you get the latest information, please subscribe and hit the notification bell. Let's get started. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled you're here. You're going to get tremendous value from the attorney that we're interviewing today. His name's Todd Robinson, and Todd specializes in multifamily real estate finance, investing, and everything soup to nuts in that arena. And actually works both sides of the fence, does a lot of work with lenders and banks and private equity firms, but also works with investors like those of you that are listening, and puts deals together, does syndications and finance, and even helps in litigation, and really has a soup to nuts all the way from the purchase and sale agreement all the way through to closing. Todd, welcome to the show, my friend.
Thanks, Rod. Thanks very much for having me, and I appreciate the opportunity.
Absolutely. So let's talk about let's talk about some of the things that you do in this arena. And then I want to dig into some of the issues that you've seen, maybe some of the mistakes you've seen people make, and why it's important to have someone like you on an investor's team, because most of my listeners are investors. So take it away, my friend.
Yeah, absolutely, Rod. And yeah, as you mentioned, I primarily represent real estate investors in the multifamily space. I do have some other real estate investing clients that are buying and selling office buildings, retail strip centers, and the like. And really, my services are kind of all encompassing when it comes to working with these investors. And I consider myself a partner on their team, not just a service provider, sucking the well dry. I would consider myself an integral part of any sort of real estate investing team that's going to buy and sell assets. And so really, when a client comes to me with a deal, as soon as they execute the LOI, they're flipping it over to me, and I'm working with them on strategies, on the equity raise, on structuring. How are we going to syndicate this deal? And if we need to syndicate the deal, what kind of preferred return are we going to offer? What is the market saying we need to offer? And then we get into negotiating the purchase and sale agreement, and I think we can get into the weeds on that, because there's lots of strategies and pitfalls on both the sale side and the buy side that I think are overlooked sometimes in the purchase and sale agreement, that end up coming down to the wire, become an issue at closing sometimes.
No, I'd love to dig into that. Yeah. Just to circle back to something you just said, I didn't realize that you actually got involved, in the discussions relating to the syndication structure. Returns, how to actually set up, if there's going to be a preferred return, the splits. So you get into all of that. So you get into the weeds.
Correct. Yeah. So I'm structuring the companies. I'm structuring the operating agreements for these syndicated deals. If it's a joint venture partnership with an equity group, we had a big deal in Houston, a $30 million deal recently, where the borrower was partnering with an equity group and an equity fund who was putting in 70% of the equity. Well, we had to end up syndicating that at the holdco level versus the propco level, and so it was a little bit more complex. But yeah, I'm discussing that with the clients from day one.
Okay, no, I love it. So let's talk about some of the things that you are engaged to handle. I mean, we've already spoken about some of them, but let's maybe a little more on a micro level for someone that's never done a larger deal. And there's a lot of people listening that have done 8 plexes, 20 plex, 20 unit, 30 unit, but have never syndicated, never done pulled in equity from other investors. So it sounds to me like they would engage you once they're at the LOI stage. Should they? I would guess they should have already talked to you and started a relationship. And can you speak to that a little bit?
Correct. Yeah, absolutely. There's a group that just came down from New York this week that I had lunch with. That's a new client of mine. And, Atlanta is a very hot market. Georgia is a very hot market, as you're well aware. And so these guys came down, and they're really just starting their partnership. Uh, and I am actually going to create just their general holding company partnership agreement. But they came down just to meet with brokers and find properties. They didn't know a lot of people down here. So first thing we did is we had lunch, and I sent out probably 3 or 4 emails to the brokers that I know in the Atlanta area. And they wound up touring a property based on one of my recommendations. So I think, yeah, initially, if investors are interested, it would be prudent to get legal counsel involved really before you even identify the property, so that we can start having those conversations. One of the things I asked these guys, they are green, brand new into the industry. I said, well, first, do you have lending contacts? Do you have lender connections? Because if you don't, you can find all the properties that you think are great deals, but if you don't have a solid lending partner to close those deals, it's going to be difficult. And also, as you know, the off-market deals are the ones that are the most beneficial most of the time. In order to develop that off-market network, you need to be working with the brokers. You need to be paying a lot of attention to the brokers, because these brokers, they have listed deals, but they often have 5 or 6 back pocket deals that are not listed that they're really going to send out to the people they have close relationships with.
Yeah, no question. So, I was going to dig into segue into building a team, and brokers, and it's wonderful that you're certainly very well connected in Atlanta, probably on the lender front as well as the broker front. And guys, this is how you build your team. It's always done through referrals. It's not like get the yellow pages or Google or whatever to find the people on your team. You do it through referrals. And so, Todd just described why it's so critical to start these relationships up front. And referrals are the way to go. And you want to start these relationships. You start them on, let's say you're investing, let's use Atlanta because that's where Todd's from. Let's say you're in New York, like these clients that he just met with. You start that relationship over the phone, and you start the relationships even with brokers over the phone. You ask for referrals, even property management companies, lenders, all these different team members that you're going to need in whatever market you're going to focus on. But then you've got to go break bread with them. And I'm so glad you brought up the fact that they came down and had lunch with you guys. That is so critical. You can't just do these relationships over the phone and wonder why you're not getting deals, why you're not getting attention. People need to see that you're real, and that, see your integrity, see your passion. Do you agree, Todd?
Oh, absolutely. I am a big proponent of face-to-face meetings, even with my clients. I have clients all over the country, and I will visit them on a routine basis. I have a lot of clients in New York. I'm in New York probably every other month, just making the rounds, meeting with people, having lunch, FaceTime, going to office visits, letting them know I'm there for them, and letting them know that, it's just a way to deepen that connection and deepen that relationship.
Right. And of course, this is, you've got your finger on the pulse of what's going on in your marketplace. So you're going to know the people that are real. I hear horror stories from students sometimes, and certainly associates that, they for example, we're pushing forward with a private equity firm, and thought they had their money locked up, and then they basically they're unscrupulous firms out there, and things happen along those lines that are not positive. And so it's so critical that you get referrals from from people like yourself and build those relationships. So let's talk about, so you start the relationship, you have the relationship going, you get an LOI going on a property, then someone would engage you at that point. No, actually, let's circle back. You mentioned that you're even helping these clients with their partnership agreement, which, guys, is critical. I have a long document I give my coaching students that speaks to all of the hard questions you have to ask and answer up front. Would you agree, Todd? You've got to ask those hard questions.
Absolutely. How are the distributions going to be split? How are the expenses going to be shared? Who's going to manage the LLC? Now, not just the property, but who's going to be a manager of the LLC? Are they going to get paid for managing the LLC? Is there going to be a buyout clause with the other partners? What if one partner wants to transfer his interest to his wife? Are the other partners going to agree to that? How are you going to address that down the road? So the purpose of especially when you're, generally these partnerships for real estate investors are 2, 3, 4 people.
Right.
You're going to have to, and the purpose of the partnership agreement is to try to identify all of those potential issues that could happen 5, 10, 15 years from now.
Yeah. Yeah.
I counsel clients quite a bit on those issues up front.
Right. You have to. And I've been in partnerships that have been huge successes, and I've been in some that have failed. And the ones that have failed for 2 reasons. One, we didn't ask the hard questions up front, or 2, the communication broke down. And guys, ask me how I know. That's my stock line at my live events. So I created a list of questions, some of which all of which are the ones you just mentioned that need to be asked up front. The first question actually is, do you actually need a partner? That's the first question,
right.
Because sometimes you don't. But so important to ask those questions up front. So you start there, and then let's say you've got an accepted LOI, and they bring you in. What are the sorts of things that you would help them with? Let's say they're going to syndicate. So let's kind of micro down the different documents that you would help prepare, the different things that, people should be thinking about, and just kind of have some fun going back and forth on that.
Yeah, definitely. Well, there's a deal that we're working on in Atlanta at the moment that we're in that stage where the LOI was just executed. The buyer, they called for highest and best offers. Mm-hmm. My client got the winning bid, and we're off to the races. And so typically the LOI has a turnaround time to get the purchase and sale agreement prepared. Mm-hmm. So that would be my next question. Who's going to prepare the PSA? Is it going to be the seller? Is it going to be the buyer? It really doesn't matter. In this instance, the seller's doing it. But as buyer's counsel, I'm going to, redline the heck out of that document, because I'm sure it's going to be one-sided. It's going to be really in the seller's favor. You can't just take these documents at face value, because there's going to be a lot of things in there, a lot of traps in there that at the end of the day, if it comes down to, what does the document say? Oh, it's going to be in the seller's favor.
Sure. Let me stop you 1 second. Guys, don't ever do a deal without having an attorney review the contract. I don't care if it's a real estate commission approved contract. Make sure you bring in an attorney to review it. I've written contracts. I've been doing this for 40 years, and I wouldn't even consider doing a deal. I've done thousands of them. I wouldn't consider doing one without an attorney to review the contract, because you're going to miss things. And every time. Would you agree, Todd?
Absolutely. And the real estate commission approved contracts are often the worst contracts to put a deal under contract with.
There you go. Yeah. So I get that question all the time. And so, I've got a broker that's preparing the contract, and he's using a real estate approved form. Do I need to have an attorney look at it? Yes. The answer is always yes. So,
right. I mean, brokers do not view the contracts under the same lens. They're looking maybe holistically with a 30,000 foot view. What are the deal terms? What's the purchase price? When's the closing date? And that's it. There's so much meat in between getting under contract and getting it closed that they're not going to pay much attention to that attorneys are generally trained to look for.
Can you speak to, since we're on the topic, and we're going to move into the other documents as well, but can you speak to some of the traps that you see? Like, let's say you're a buyer and a seller's attorney prepares the contract. I didn't prepare you for any of this, so that's probably not fair. But can you any pop to mind? Anything pop to mind that's like sneakily put in there, maybe?
Yep. So a couple things that pop to mind. One would be survival of the representations and warranties. So the seller is going to make certain reps and warranties about the property, about the condition of the property, that you want those representations to survive, meaning extend beyond the closing date for as long as possible.
Right.
If I'm preparing a contract, I start out with a year. Now that's really too long. Most sellers, if a seller has a sophisticated counsel on the other side, they're going to knock that down to 90 days, and we end up between somewhere 90 days and 6 months.
Okay.
But you want those representations to survive so that after closing, you get in there and you say, oh my gosh, these guys completely misrepresented the state of the property.
Complete BS. And that happens.
The rent roll was false. Right. There's deferred maintenance that wasn't disclosed. All of these issues. Well, now you can go back to the contract and say, hey, seller, you represented that the roof was 10 years old. Well, come to find out, I found a receipt. It's 30 years old. Now I got to pay $100,000 to get it fixed. If you're within that representation and warranty, the survival period, you can absolutely go back and make a claim against the seller. Again, we're getting into litigation issues, but that's a very important provision to have.
And sometimes you have to litigate. Unfortunately, that is this business, and we are a very litigious society, which is why you're so wealthy, Todd. But no, I'm kidding.
Yeah, the other one that's I think very important on the buyer side is the rent readiness provision.
Rent readiness. Okay, speak to that.
So what that means is the vacant units in a deal. You will have a representation that the seller will have those units in rent-ready condition. And rent-ready condition can be a defined term under the document, and it usually means the carpets are cleaned, the counters are wiped down. It's in move-in ready condition. And in my contracts, I will have a provision that makes the seller affirm that they will be in rent-ready condition. And if they're not in rent-ready condition at closing, then the buyer will get either a credit on the closing statement of a certain amount, or the seller will pay the buyer after closing a certain amount. Usually it's between $3,500 and $1,500 per unit. But I had a deal a couple months ago where, and the way to test that is the day before closing, buyer should do a walkthrough of every single vacant unit. And then it's often, a down to the wire negotiation, but if the buyer comes back and says, hey, these 10 units are not rent ready, the seller agrees, $3,000 per unit, that's another $15,000 off your purchase price potentially that you just negotiated down.
Yeah, and one thing he said, guys, that's really important is because of the subjective nature of rent ready, it's probably not a bad idea to define exactly what that means. Otherwise, you get into a definition argument. Yeah, very good, very good. Okay, so any other traps top of mind? Okay,
sure. Closing costs. Who's paying for closing costs? Now, typically those, in the purchase and sale agreement, that should be laid out specifically. But I will often see sellers' attorneys will put in their items on the closing statement or in the closing costs that would typically be paid for by the seller. That's according to local custom. You'll see that in documents. Right. Well, what's according to local custom? Like, for instance, in Florida, the seller usually pays for the title insurance premium.
Right.
In Georgia, where I'm located, the buyer always pays for the title insurance.
Oh, interesting. Okay.
So you got to make sure that the contract conforms to those local customs and rules. And if, for instance, if there's escrow and settlement fees charged by the title company, that's generally shared 50-50 between the seller and the buyer. But some contracts could say that the buyer pays 100% of the escrow and the settlement fees. So you really don't want to pay close attention to those closing costs.
Okay. Yeah, no, that's a real good. Now, obviously, customs are customs; they're not laws. But right. It's believe it or not, most people stick with those unstated rules. Right. In most jurisdictions. So
another one I would just mention is the seller's obligation to maintain the state of the property during the pendency of the contract. We had a deal recently where and even though the seller's typically under most contracts, sellers required to do that, but you want to be very clear that if the seller is going to be renting new units during the pendency of the contract, that those rental rates are consistent with the established rental rates currently in place. Yeah. That the seller's not giving away a free rent in order to get the occupancy up, because these, they can manipulate the numbers, they can manipulate the vacancy, that you can have defaulting tenants who are not paying rent that should be evicted, but since we got to provide a rent roll at closing, we're not going to evict them so we can show the occupancies at 95%, when really it should be at 80% because these guys should be out of the property.
Right. And, and to get Fannie or Freddie financing, it's the 90 for 90. You need to be above 90% occupancy for the last 90 days. And you're right. I mean, they will play with it to make sure that nothing happens there that kills the deal. Right. So very, very important. Good stuff. Okay, so that's the contract. What other documentation would an attorney like yourself help with in a transaction? So let's drill down.
Sure. So if the purchaser, the real estate investor, is going to syndicate the deal,
Mm-hmm.
then the next step would be figuring out that structure and figuring out where the equity is going to come from. That's always my first question. Okay, guys, we got a $5 million deal. We need $3 million of equity or $4 million of equity. Where is it coming from?
Mm-hmm.
If it's coming from your pockets, then we don't need to syndicate the deal. We'll just do a joint venture, single purpose entity for the property, and we'll be good. But if
let me stop you one second. So, guys, if like right now we're doing a joint venture deal in my backyard here, and because all of the partners or all of the equity players are active in the deal, it can be a joint venture. Now, if you take money from someone and you just give them a return, you have to syndicate. Okay, so I just want to flag that. Okay, please continue.
That's right. So under that instance, you are then entering into securities private offering regulations, and will have to comply with Regulation D of the Securities Act. Mm-hmm. And so at that instance, we typically create the property company, called the PropCo, and we create the manager entity, which is going to be the company that will manage the property. And the PropCo will syndicate limited partnership interests to the investors that in exchange for a preferred return in the PropCo. Mm-hmm. Typically, the rates of return can be anywhere between 8 and 10%. Mm-hmm. Now, if this is a more stabilized asset and it's not really a value add play, I was talking to a client recently about, maybe we offer 6% because there's not going to be a lot of upside on the sale. Because we're not doing a lot of value add right now. And I think, Rod, I'm sure as well as anyone, that where we are in the cycle, right, a lot of the value add deals are gone.
Yeah. We've actually got, for us, it's been feast or famine. We've got almost 1,000 doors we're raising money for right now. And they're all really, really solid deals. And I can say that because we're only dealing with 506C accredited investors, but they are tough. We've kissed a ton of frogs to find these deals, and I think most of them were brought to us by our students. But they're all screaming good deals. But let me circle back to something you said on the PropCo. Is that it's normally an LLC? Yes.
Yes, it's normally an LLC. That's generally the preferred corporate structure. It can be a partnership. It can be a limited partnership agreement. But generally it's an LLC. And so you're syndicating what the investors will be purchasing are called membership interests in the LLC. And if you're syndicating it, you usually have two different classes of shares. Right. Class A is the preferred share that you're gonna sell to your investors. And we can figure out what that value is going to be, what that preferred return is going to be. The Class B shares are really kind of just the profit interest shares that the managers would have, or the GPs. I interchange GP, LP, even though that's more of a partnership, but it's just easier to talk about it that way. But the sponsors of the deal are going to be holding the Class B shares in the PropCo.
Right. And that's just semantics. It could be, you could reverse the A and B, but I think it's been A for a long time because it makes the equity investors feel better that they're getting A shares instead of B shares. Yeah, I remember when it was all limited partnerships, and why? Just to humor me for a second. I mean, before LLC were even thought up, I remember it was all limited partnerships. Why would someone do a limited partnership now versus an LLC? Is there aren't really any advantages, are there?
There, not that I'm aware of. Okay. I mean, the general laws of each state are, LLC, limited liability company acts, are generally the same as partnerships. A lot of people switched away from limited partnerships to LLCs is because if it's a limited partnership, usually the general partner of the limited partnership will have full liability. And so to address that issue, the powers that be, the limited liability companies. And so
I used to have a separate entity be the general partner of a limited partnership, and it was just a pain in the butt. I still actually have a couple of them left, but LLCs are just so much better. All right, we digress. But so you're going to do the PropCo, then you're going to do the which is where you clearly define those returns and or splits rather, and preferred return, and all of that. And then you said the management one. So speak to the management company.
Correct. Yeah. So the management, that's really, that's the sponsors entity. So that's the entity that is going to get the profit split from the operations of the property. Now, if you want to speak to waterfalls, we can get pretty into the weeds about that. Some people, real estate investors and sponsors will do a waterfall. And when we say waterfall, what we mean is, initially the split is 70% of the profits to the investors, 30% to the sponsors, until the rate of return reaches a certain benchmark, which is called an internal rate of return. That internal rate of return, say the preferred interest is 8%. Well, when the internal rate of return reaches 10%, that profit split from 70-30 goes to 60-40.
Yeah. Yeah, we do deals like that, and that's just incentivizing the GP team, the general partners, as it were, KPs, key principals, to kick butt and do well, and that will confuse some equity investors sometimes. Sometimes it is a little confusing, but we do that. If we hit 20% IRR, we go to 50-50, and frankly, it's fair.
It's fair. But, yeah, exactly. It incentivizes the sponsor group to make that property hum, push rents, add, get in good tenants, things like that.
Sure. It's a win-win. It's a win all the way around. So back to the management company. Speak to that a little bit.
So I call it the management company because it's really just the manager of the propco. So it's really just a separate LLC. But sometimes the way I structure it is I'll call it, if it's 123 Main Street LLC, that's the propco, and then it's 123 Main Street Manager LLC, and that's just the entity that is owned by the sponsors,
by the GPs, the KPs, the sponsors. So, guys, just so you get that, so the propco is the one that defines the equity, your equity investors, and the GPs, as it were, and then the management company is you and your fellow sponsors, your other GPs. That's how you're going to hold your interest in the propco. Okay, so let's say it's a 70-30 split. Your 30% as an operator sponsor will be in that management company.
That's right. That's right.
Good.
And then even at that point, the 30% example is shared pro rata between the members of the managing company. Right.
If there's three, to keep it simple, let's say you've got three sponsors, three KPs, three GPs, same thing. And let's say they're split equally, then effectively in that deal, you'd have 10% each effectively.
Right.
Okay.
Yep.
All right. So what other documents would you do in that scenario that'll help people understand kind of the back end structure to this?
Right. Well, if you're doing a 506B or 506C offering, the difference there is whether you're going to sell the membership interests only to accredited investors, or you're going to have some unaccredited investors. And 506B is up to 35 unaccredited investors. But the main disclosure document that the sponsor will need is called a private placement memorandum. That is my standard PPM form is pretty long. It's got a lot of disclosures in it because you always want to over disclose rather than under disclose.
Right.
This is a document that the Securities and Exchange Commission likes to see because you want to disclose all of the risks of an equity investment to an investor.
Sure, the world could end. I mean, you take it to that level, and it needs to be a scary document that protects you. The more onerous it is, the less chance somebody can say you didn't warn them.
Right.
If deals go south.
Exactly.
And there are operators out there right now doing deals that frankly make the hair on the back of my neck stand up. We're right now we're doing 65% loan to value and because we're very conservative. But there's some scary deals being done right now. And so in that vein, make sure you're well protected because, when there's a hiccup, that's when all this stuff comes to light. When an investor has an issue, that's when all this stuff comes to light, and they pull out these documents and make sure, see if they've got something to hang their hat on to, go after the sponsors.
Right, exactly. And kind of simultaneously while I'm working on the PPM and the syndication documents, the sponsor team is doing the underwriting and running the numbers and making sure the deal makes sense, because those numbers need to be in the PPM because we're disclosing the entire deal to the investors.
Mm-hmm.
So we have to make sure the underwriting is pretty solid
Right.
before we circulate those documents.
Nice. Okay, so you do the PPM, then of course you do what's called the subscription documents,
Right.
which is what they sign to say they're going to participate in the deal.
Correct.
Anything else that we're forgetting here that you might be involved
No,
in?
those are the main highlights. I mean, the operating agreement, the PPM, and the subscription documents is what you would need. Sometimes there's investor questionnaires that you'll have the accredited fill out. There's a duty on the sponsors to get an understanding. If someone says they're accredited investors, there's a duty on the sponsors to verify that information. Yep. So we can do that through an investor questionnaire, and as long as we get their answers, there's really no duty beyond getting the questionnaire answered. It's not like the sponsor has to go and check bank accounts and things like that to make sure they're actually accredited.
Okay. And so let me ask you this. So what sorts of mistakes have you seen made? And again, I know you weren't ready for this question, but
Sure.
but what sorts of mistakes or issues have you seen either from other attorneys or someone tried to do it themselves or even represented people that just things that have popped up that might help my listeners prevent a seminar?
Yeah. No, I have a pretty interesting kind of war story I could tell.
Okay, great. Perfect.
To that effect. And it was a deal that we had in Houston. And
so let me ask you this. I'm sorry. Let me ask you this. So you practice, I know you're based in Georgia, but do you do real estate transactional work all over the country? Do you specialize in particular states? Speak to that for a minute.
Yeah, no, I do real estate transactions all over the country. I mean, my bar license is in Georgia, but I can certainly, I have clients all over the country and I represent them in deals all over the country. And if there's a deal out of my jurisdiction, and what we'll typically do is get what's called a local counsel that I associate with that helps me understand if there's any particular local rules that I need to be aware of. I'll often have them review the security deed to make sure it complies with local customs and things like that. But
state specific stuff. Yep. Okay. No, that's good. I'm really glad that I asked. So
yeah.
Okay. So let's hear that. Let's hear that Houston war story. I've got great friends that are syndicators in Houston. In fact, I was just there, a couple months ago, speaking to a few hundred people. I did a keynote to a group. Anyway.
So this was a pretty large, heavy value add deal. It was a $25 million purchase, and I think I'm in a ballpark here, but it was a 500 unit deal, and like 250 units were down.
Wow,
so
that's a heavy lift.
Huge, huge. The loan was $35 million. It was just a big deal, and the sponsor group, who got it under contract, partnered with an equity fund, a private equity fund out of New York, to put in all the equity, 70% of the equity.
Who were you representing?
I was representing the borrowers, the sponsor.
Okay.
And I put the syndication deal together. I didn't do the purchase and sale agreement. They actually had the local counsel do that, but I was brought in really to help negotiate the loan docs and to help with the syndication piece of it. But, and I'm probably some of these sponsors are going to listen to this podcast, so it'll be interesting to get their feedback. But they were, my opinion, they were green, a little green, and it was a large deal. It was a big deal. And I think they could have handled it. I really honestly do. But I started getting some concerns from the equity partner about the way the sponsorship group was structured. And I say that to mean there was 5 or 6 of them that were in the deal. And the equity fund just wasn't getting the warm and fuzzies with these guys. And so, he didn't get a clear picture of who was going to be responsible for the construction. Who's going to oversee
that's an important question. When
Right.
you've got 200 vacant units, they
Right.
better know what the hell they're doing. I mean, that's
Right.
a logistical project there.
Right. And these guys were all in different states. And
Oh, wow.
so there wasn't really going to be like the boots on the ground guy that's going to be in Houston that could handle it. So the equity fund ended up having a real problem with that. And so who's responsible for the construction? Who's going to process the draws? Who's going to work on the tax credit issue?
And guys, just so you know, that whole draw structure is a really big deal because you need to know how your lender treats those, because those are big checks. And if you're waiting 30 days for one of those checks and you don't have a big operating reserve, that's a recipe for a nightmare.
Absolutely.
Do you agree, Todd?
Good. Yeah, very good point. Very good point. Okay. Yeah, because the minute that construction is delayed, you're getting into a domino situation, and it's really hard to come back from that.
Right.
So the long and the short of that story is that the equity group pulled out of the deal weeks before closing, if not a week before closing. Just said I'm not comfortable with the sponsor group. Now I think the deal could have gotten done. I think it would have been fine, but it's his money. It's his $7 million. So he pulled out of it.
Wow.
And I will say though, he even though he pulled out of it, he made everyone whole, which was, I think, a really noble thing to do. He ended up paying the acquisition fee to the sponsor. He paid the legal fees. He paid all of the fees so that the sponsor group ended up back at zero. They didn't lose anything, but they lost the deal.
They lost the deal.
And so I guess the message there is if you're going to get into these larger deals, you got to make sure you have a solid business plan, a solid structure. You're identifying what roles people are going to have, and you can present a really consistent picture to these equity funds and these other groups.
Sure.
Funny enough, I had, so the sponsor group had around $3 million that they raised on their own, in addition to the equity fund that was coming in. And simultaneously, at the same time, I had a deal in Atlanta that was closing like the next day. So in a matter of a couple of days, I contacted the sponsor group out of Houston. I said, guys, I know this deal's gone, but my other client over here needs about $3 million.
Perfect.
And so they ended up funneling the money into that deal. And it turns out that deal's just a cash cow. It's going to be a great project.
All's well that ends well.
All's well that ends well. Exactly. But if your listeners are getting into larger deals, they're starting to find equity partners, that's the one thing they're going to look for. What's you guys consistent? What's your track record? Who's going to do what? And I want to harp back on something you mentioned a little while ago was a lot of these groups or equity funds or private equity funds or joint venture partners, a lot of them have the word equity or capital in their name, but most of the times they don't have either one. And so I've actually litigated quite a few cases where these real estate investors are signing term sheets. They're putting down $50,000 to the JV, to the equity fund, and then a couple of days before closing, the equity fund disappears and they don't return their $50,000.
No kidding. Yeah. See, I'm really glad you brought that up because I've got students that have been right before closing and have equity funds kill the deal, and then they end up buying the deal because they bailed and. So there's some unscrupulous players out there, guys, and this is why you must get referrals. In fact, I'm doing a deal right now that looks like we're going to shift over to bridge debt, and I'm asking for referrals, okay? Because I'm a little uncomfortable with bridge debt in this current economic climate because who knows what's going to happen with interest rates. So we're stress testing it to make sure it's going to be okay. But I want referrals myself. So. Very, very important. And listen, you've been a wealth of knowledge. I know you were referred to me by one of my students that's done business with you. And I'm really glad that I got to meet you and have you on the show because really has been very, very powerful interview. Any parting thoughts for investors getting into deals? Anything that I haven't brought up, that we haven't talked about, red flags, things to be aware of, anything that I missed?
Yeah, no, I really appreciate the opportunity to come on. And I think the biggest, moral of the story or parting thoughts would be that, buy it right. Don't overpay for the product. Make sure, as you mentioned earlier, building that team, having that support staff is critical. And if you do it right, investing in multifamily can be, a lifetime of wealth and happiness.
Yep.
Do it wrong, it could be a real problem.
It can be a seminar. It can be a seminar. Yeah,
Right.
No question. Well, listen, it's Robinson Law in Atlanta. I'll put the contact information in the show notes. Very much a pleasure to meet you and spend some time with you. And we are definitely going to stay in touch.
Absolutely.
Thanks, Todd.
I appreciate it. Thanks so much.
All right, buddy. See you.
Yeah.
Hey, thanks for watching. Please subscribe to my channel. And if you listen to podcasts, join me on iTunes, Stitcher, or wherever you listen to those podcasts. Just search for Lifetime Cash Flow through Real Estate Investing.
Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws.